Hi, in this video, we're going to cover a quick intro to financial statements. What are the three major financial statements? What are they used for? And what do they tell us when we are evaluating any particular business? We'll also try and understand how does the construction of one of these statements like the balance sheet kind of play out when we're running the business, right? My name is Piyush. Welcome once again to another video on our channel. If you haven't subscribed it as yet, please do that right away. Let's jump right into the context of financial statements. When we talk about financial statements, the first thing that we need to kind of talk about is the concept of a financial year. So when we are building accounts for a particular business, then we are looking at particular period of time for which these financial statements are getting created. This period, when we look at the year, is basically what is called as the financial year. Now, the concept of accounting year or financial year can vary from geography to geography. Here in India, we consider it from April of a particular year to March of the next year, and that's the financial year. So if I say financial year 25-26, if we are looking at that, this will start in April of 2025, and this will go on till March of 2026. That's the period for which this financial year would basically appear, right? Now in this April, May, June is going to be quarter one. July, August, September is going to be quarter two. October, November, December is going to be quarter three. And Jan, Feb, March consequently will end up becoming quarter four. So when a company comes out with quarter four results, for example, that will be Jan, Feb, March. Now, please note that it doesn't necessarily have to be April to March. Some companies can follow Jan to December as well. Globally, we find in the US, most companies follow a calendar year. But in India here, we have April to March as the accounting year that we look at. So let's now turn our attention to the three financial statements as we look at them. There are three broad financial statements that would come out, which would be the profit and loss statement, the cash flow statement, and the balance sheet, right? As the name suggests, the profit and loss statement is basically like a report card for a business, right? It's telling you what is the business earning through whatever they are doing and what is the cost of actually running this activity, right? So whatever activity they are doing, let's say they are selling marker pens, then what is the revenue they are generating out of selling it? Whatever sales they have done, that's called revenue. And whatever is the cost of running this operation, which is, raw material cost or salaries that they're paying, those all will be classified as expenses. So income versus expenses, a report card of the business, which basically tells me what's the profitability of a business. That's what is called as the profit and loss statement. It's also called as the income statement. That is also the same thing essentially. Then we have something called as the cash flow statement. Now, the cash flow statement visualizes something like your bank account. Money coming in the business, money going out of the business, funds coming in, funds going out, that is all recorded as a cash flow, right? So if I am basically, let's say, buying a factory, this is not necessarily my day-to-day course of business, or I'm buying a mutual fund out of the company money. This is not a day-to-day activity, so it may not get recorded directly in the P&L statement or profit and loss statement. But because money is going out, this will get recorded in the cash flow statement. So cash is the sort of lifeblood of the business. So we want to kind of understand what kind of cash inflow and outflow is happening. That is what is captured in the cash flow statement. The balance sheet gives you a glimpse of what the business owns and what the business owes, right? So basically, what do you own versus what do you owe? You can also think of it, some people have given us the money to run this business. These people could be debt holders who have given us a loan, or they could be equity holders who have bought a stake in our business. They've given us the money. This is source of funds. We have to return it to them. This is a liability. This is what we owe. Now we can use that money to go and buy business generating assets. This is what we own, right? So any assets that we own, this could be a factory, this could be a vehicle, this could be anything that is generating activity and generating business for us, right? Raw materials, inventory, all of this is a part of the asset side, right? But any borrowing I have done, anything that somebody has given to me in order to run this business here, which I have to return at some point of time, that's basically a liability which is going to come under the balance sheet, right? When you look at these three statements, two of these statements are periodic, right? So your P&L statement and your cash flow statement both are periodic, which means it is for a particular period. It's Jan to December, right? Or April to March. For the last 1 year, what is my profit? I don't say my profit now is 100 crore. I'll say my profit for the last year is 100 crore, right? Similarly, cash flow is also for a period. Within that period, how much money came in, how much money went out, that's what is considered in the cash flow statement. Balance sheet, on the other hand, is at a point of time, which is right now. What do I own and what do I owe? The very next moment I could take another loan and then, the structure could change at that point of time. So balance sheet is a point of time statement. Think of it as a snap that you've picked up on your phone. Whereas P&L and cash flow statements are during a particular period. Think of them as a video that you have taken on your phone, right? So that's the construct of the various financial statements. What they tell is different parts of the business, and you can only look at the entire business in totality once you've looked at all three of them in cohesion, right? So that's the context of the financial statement. Now let's turn our attention to how do you run a particular business and how does balance sheet basically get started getting constructed? How to kind of arrive at that, right? So let's assume we start a business and there are two shareholders in this business. Let's call them A and B, right? A and B together put about 100,000 rupees or 1 lakh rupee into the business. They own 50% each in the business. So shareholder A and shareholder B both own 50% in the business. Let's assume they have initiated this business by buying shares in the company and each share is priced at 10 rupees. So both of them must have invested 50,000 rupees each. That's how you reach 1 lakh. Yeah. And they have bought 10 rupee shares. So the share price, they would have gotten like 5,000 shares of 10 rupee each, both of them. So we get 5,000 shares of 10 rupees each for A and B. They put this money in the company. Now, what you're constructing is the balance sheet of the business. So on the liability side, this is also what is called as source of funds. You are getting 100,000 or 1 lakh rupees as share capital that has come into the business. That's basically 10,000 shares into 10 rupees. That's what we have arrived at in terms of 1 lakh rupees. On the asset side, which is going to become application of funds, we actually have cash and bank balances at this point of time. Company ka ek bank account hoga. So whatever money the shareholders have put in, that money is lying in the bank account at this point of time. As you will see, both the sides of the balance sheet are balancing because obviously, you've taken money, you've either used it or not used it. At this point, it's unused. So you see 1 lakh on one side, 1 lakh on the other side, and the balance sheet is balancing. Every decision that the business takes from here on is going to either change both sides of the balance sheet or rearrange items on one side of the balance sheet, right? So assume that now this business starts doing some business and they buy some assets out of it. So let's say they buy some fixed assets worth 1 lakh rupees. So what's going to happen is you're going to see this kind of a structure happening where money has now gotten rearranged because money has gone out from your bank account and you've purchased, let's say, a fixed asset out of it, maybe some furniture, maybe some computer, something out of it has been purchased at this point of time. Now you start running the business during the course of the year. As you do this business over the course of the year, you end up making some kind of profit. For simplicity, assume this is final profit and you've taken all kinds of expenses. All kinds of expenses basically taking care of the fact that assets have to be kept in a fine condition so that they are good to work next year as well. So if my asset value was 1 lakh at the beginning of the year, assume I have kind of made an upgrade and it stays at 1 lakh at the end of the year after taking all those expenses. Let's assume the company or the business makes a profit of 20,000 rupees. So at this stage, this is an intermediate stage, you will see that the bank account of this business has 20,000 rupees extra. And now they have to decide what to do with that. So there are 2 or 3 options out of it. Option 1 is they could choose to return it to the shareholders. If they choose to return it to the shareholders, they will give it out in the form of dividend. Remember, A and B both had 50% stake each. A and B have 50% stake each. So out of the 20,000, both will get 10,000 each if everything is given out as dividend. Now, A and B the investors might be thinking that, look, we just gave the company some money. We don't really need this money, right, at this point. And the company seems to be doing good because we gave 1 lakh rupees and the company has generated 20,000 on it. So that's like a good 20% return. This term is what is called as return on equity, but more on that some other time. Intuitively, you've given 1 lakh rupees, you have generated 20,000 on it, you would be happy. What will you do with the money? So you can choose to say that, okay, let's not take this money out. Let's reinvest this money into the business. Right? Now remember, whose money is this? The shareholders. Because this money is for the shareholders, the money has to be shown as what is owed to the shareholders. Correct? So what will happen is on the liability side, I need to show this 20,000 because I owe it to the shareholders. It's not paid today, but it has to be paid at some point of time. That's their claim in the business. Correct? So I will add a line item on the liability side and call that reserves. Reserves and surplus, right? Or retained earnings or other equity. Now, when I look at the balance sheet now, you will see the left liabilities side would appear to be 120,000 and the assets side would also appear to be 120,000, thereby balancing the balance sheet. Now I have put this money here. Did the number of shares for the company change? No, right? Both of them started with 5,000 shares each. The company has not issued any new shares. For value has now become 1,20,000 total amount. So both of them should be having a claim of about 60,000 in the business. If both of them have a claim of 60,000 in the business, the new share price is going to become 12 rupees. Right? This amount, 12 rupees or 10 rupees, which is a sort of an equivalent value of that share that exists, is what is called as the book value of the stock, right? Because it's as per the books of accounts. So that is what is called as the book value for the stock. That has become 12. So even though A and B, the shareholders, have not taken out of the money from the business has to show in some form or fashion that the value of their investment has moved, right? Because of this, the book value of the stock will move from 10 to 12. Assume next year they make another profit, right? And this 20,000 is reinvested into the business. So your fixed assets become 1,20,000. And then end of next year, they end up making another profit. And let's say they make a profit of 30,000. So the asset side will be 1,50,000 now. On the liability side, last year's 20,000 was pending to be paid. Another 30,000 has gotten, let's say, reinvested in the business. So the balance sheet should appear like this, where the reserves will become 50,000. So there are two things that come out of it. One, on the balance sheet, things like the reserves are cumulative in nature. So they keep adding up. Last year number plus this year number plus this next year and so on and so forth. The second thing is both shareholders A and B continue to hold 5,000 shares each. That doesn't change because the claim is now 1,50,000. The share price must have moved to 15 rupees. Book value, remember, in the stock market, if this stock was listed, the transaction price could be anything. It could be 10, it could be 12, it could be 15, it could be 20, it could be 100, depending on what the market believes lies in the future. But if you look at books of accounts, basically, what you're saying is as per the balance sheet, the claim of these shareholders, first year was 10 rupees per share. Second year, if you close the business at the end of the second year, close the business, sell all the assets, you will repay 1,20,000 here. That should be effectively 12 rupees per share, right? At the end of the third year, if you close and sell the business, shareholders will get 15 rupees each. That is what is denoted as the book value. And this can just go on and on and on. For any business that has lasted a few years, naturally the reserves number will become a much bigger component in the business because every year you're reinvesting some or the other part into this. So that's how the nature of the business works. So very simply put, if you were to kind of put this in a particular business model, what's happening is a company is getting money in the form of either shareholder funds, which is called as equity. They are buying a share in the business, or you can take loans, which is also called as debt. You can raise money through these two formats. Take this money, you can buy some business generating assets. So you can buy assets out of this, Once you have these assets, the asset generates cash flows or business or profitability. So you'll get some profits and cash flows out of the business. For now, I'm keeping those terms simple and similar. In real life, profits and cash flows could differ a little bit, but let's assume company makes some profits. Now they will use this money to return money back to lenders, interest plus debt repayment, or to shareholders in the form of dividends. If they do not give entire amount of their profits out to shareholders as dividends, then we are going to basically put that back in the company, which is going to be called as retained earnings, that will go and sit again in shareholder funds, gets added to the initial amount of money that shareholders had put in, and now keeps getting reinvested in the business. Next year growth will keep coming from that, right? That in a nutshell is how a very basic balance sheet mechanics would start working. You keep complicating this further with adding more and more steps into the business. But the intuitive sense is whatever you do, either it's going to change both sides of the balance sheet or it is going to rearrange items on one side of the balance sheet. That was a very basic primer on the financial statements. That's it in this particular video. My name is Piyush and please leave your feedback in the comment section. Thank you.